Hey everyone, it's Konrad Bobilak here, CEO of Investors Prime Real Estate and best-selling international author of Australian Real Estate Investing Made Simple. Welcome to 2026. What I'm going to do today is a very important video because I'm going to share with you some of the insights and forecasts for 2026. Specifically, I'm going to talk about the Melbourne property market and areas to invest in, areas to avoid, like a teen arena concert, and areas and suburbs that won't do anything, and in fact, they'll go sideways. And I'm going to unpack these topics in detail. I'm going to show you why exactly these areas will go up and why other areas won't go up. And also, I'm going to share with you probably the most fundamental resources that I use and other successful investors use to read and educate ourselves about the property market. And the best thing about these resources and newsletters and people that we follow in the media is that you can start following the same people, reading the same reports, and then get a good insight and have your finger on the pulse and learn about what's happening in the property market with using facts and then making intelligent decisions rather than following the crowds and following the media, which usually are wrong. So welcome to today's video. Grab a coffee or a V drink, sit back, relax, and enjoy. Now, a couple of things before we get started. I just want to do a bit of a disclaimer that today is not about giving you any financial advice. So I've never met you. I don't know your financial standing or your risk profile. My recommendation is before you do anything, speak to a qualified financial advisor or mortgage broker or strategist or a buyer's advocate like myself. Make sure the person you're dealing with, though, has results and has the exact same results that you have. Never take advice from broke academics because the industry is filled with them. Couple of things about myself before we get started. So I've wasted 4 years of my life at Monash University doing a business degree. Then I did an MBA, nearly did an MBA, more bad advice from broke academics, but I thought I would get out there in the real world and start making some money. So my background is predominantly banking and finance. For 12 years, I worked in private banking for NAB. I'm also a financier. So I used to do commercial lending and asset finance and residential lending for NAB and Medfin. And at the end of my career, I was in private wealth for NAB and Medfin, setting up medical clinics and dental clinics and looking after high net worth individuals. Before then, I was financial planning. And the last 12 years, nearly 13 years, I've been sourcing properties and helping property investors just like yourselves build large property portfolios right here in Melbourne. So I'm a buyer's advocate and a sourcing specialist. The most important thing, guys, is that I actually do what I preach, and I actually have a multi-million-dollar property portfolio myself. So I'm not just a theorist. I'm actually doing things myself, refinancing properties, buying properties. I'm constantly in the market, engaging with accountants, solicitors, mortgage strategists, bankers, valuers. So all the information that I'm giving on my YouTube channel is real and current. It's not theory. I'm not an academic. I'm actually in the market every day talking to very successful investors and developers. And I'm hoping to share some of these nuggets of wisdom with you to make sure that you are successful and also to, more importantly, save you from making mistakes, because there's a lot of mistakes that are made in the property market and people waste years and years of frustration and they end up buying apartments in Docklands or South Bank or house and land packages on the fringes of Melbourne, and then 10 years later wondering why they didn't go up in value. So that's my 2 cents a bit. Also, I want to thank you guys for buying my book, Australian Real Estate Investing Made Simple, and my finance book. I've made it to #1 multiple times on various platforms, including Amazon, Booktopia, etc. So I wanted to thank you guys for buying my book and supporting me. If you want to get a copy, by the way, on my real estate book, jump onto realestateMadeSimple.com.au. And for the finance one, which I'm updating at the moment, I've just finished the first draft, and I've got a whole section on trusts and how investors are buying properties through trust and virtually tapping into a never-ending, unlimited stream of income, or borrowing capacity, I should say, which creates income. It's very misunderstood how rich people use trust to leverage themselves, and I'm going to talk about that in detail. I've actually written 4 new chapters just on borrowing through trust. That book will be out later on in the year, but you can get a copy of that as well. Just jump onto bookonfinance.com.au. Okay, and also as a bonus, just because we're starting out 2026, and I really believe in education, unbiased education, the more educated you are and the better equipped you'll be to make intelligent decisions. And so if you want to get educated about the property market and how successful investors are building wealth through property, jump onto my online video course. Just as a link below. It's free. It's worth $497. It's a 2-day recording from a real estate investing fast track weekend that I did a few years ago. It's still about 70% current. The market's obviously moved on, and we're in a different part of the property cycle. But in terms of the fundamentals of structuring your property portfolio, nothing's changed. So, having something accessible for free that's still 70% current, I think it's a very good investment of your time. Because remember, you can always get more money, guys. You can't get more time. Time is always running out. It's always against you. So I hope you enjoyed that online video course. I will be updating it soon, probably this year. We'll see how we go. Now, let's talk about the market 2026. There's a lot of gurus out there at the moment. I don't know. It's a weird thing because some of these kids are so young. I think they're still living at home with their parents and they've never bought an investment property. So it's just one of those weird things. Um, there's a lot of things that are being said about the economy and the property market that are completely false. And there's correlations made between different indicators that are completely misleading. There's a lot of hotspots in Melbourne and a lot of these hotspot reports that are completely useless. I've been downloading them. I don't use my real name. I use another name because everyone knows in the industry who I am. And they're just rubbish, guys. It's just AI written. Not even human beings have written this stuff. It's AI written. It's just sad, some of these reports that are coming out about hotspots. Some of these areas are just rubbish areas in Melbourne. They're not going to do anything. You're just wasting your time and money. But obviously, the reason their reports are put together is because there's project marketing companies that want to push a project and they're selling it and they're making huge commissions. But my advice is definitely not to engage with those kind of reports. I'm going to show you today in this video exactly the areas that I'm sourcing in for my private clients this year, and which areas I'm targeting as well. So you can have a look at what kind of properties I'm sourcing. Now, if you look at the Melbourne property market, there's actually 4 key drivers that drive the Melbourne property market. There's interest rates, supply and demand of houses, population and job growth, and construction costs. Now, the worst thing that can happen is, and you can get this information in a lot of different resources. I'm not having created this methodology. The worst assumption that you can make is that there is a direct correlation between all these things with every property in Melbourne, which is the worst assumption you can make. So, for example, we know, and I'm going to cover the basic definition of these because it's important to unpack them correctly, and I'm going to go to a pretty high level. So, interest rates. Obviously, everyone's aware of interest rates. The Reserve Bank decisions matters because it affects how much it costs to borrow money. If rates go down, monthly repayments get smaller and buyers can borrow more, right? A very basic year 7 economics, right? Which usually brings more people into the market because people can buy more, they can afford more properties. If rates stay the same, conditions don't change much and buyers and sellers adjust to the current cost of loans. Now, here's the thing. Melbourne is very fragmented. There was houses recently sold in Melbourne for over $100 million off market. So Melbourne isn't one uniform market. Don't think every house in Melbourne is between 900,000 to 2 million. There are a lot of houses in places like Toorak, Hawthorn that are selling for $20, $30 million. And there's still houses in Frankston North that are selling for 650,000. So don't think that Melbourne is one market with one person looking at the market. And what happens is because people's incomes are so varied, if we get an interest rate cut of 1%, different people will be affected in different ways. Because if you're making 100,000 per year and the interest rates get cut, your borrowing capacity might go up this much, right? Which means you might go from, I'm just making this up, from 750 to 950 or from 750 to 850. But if you're making $500,000 a year and interest rate gets cut, you could go up by $1 million or half a million dollars. So it depends on your income and your serviceability. Different people with different incomes are impacted differently when interest rate gets cut. So don't assume that everyone can borrow the same amount of money because they don't. And this is where the problem lies. So obviously with interest rate cuts, it has an impact on the general market, the market around the median price, which I guess for townhouses in Melbourne is between a kind of 900 to 1.5. For houses in Melbourne, you really need 1.5 to 2.5 million. You can't get anything for $1 million worth living in Melbourne unless you want to be macheted. In those suburbs. So that's number one. Supply. Supply is huge in terms of its importance and significance on property prices. The number of properties in the market changes the balance between buyers and sellers. Low supply, fewer homes for sale, can push up prices because buyers compete for limited stock. High supply, which is an oversupply, means more homes, or means more buyers have a choice and they can slow prices down. Now, Melbourne is very fragmented. Infill areas, like let's say Carnegie Murrumbeena, there's no land left to subdivide. So if you want to build something, you have to buy something that's already existing and rip it down and redevelop it. If you go into Mernda and Point Cook and Truganina, there's thousands of homes you can build tomorrow because there's cow paddocks just behind where Point Cook finishes and Truganina finishes, and just endless supply of land. So there's not the same constraints of supply in the same suburbs. Once again, putting all the suburbs, there's 485 suburbs in Melbourne, nearly 500 suburbs now. There's all these new pop-up suburbs that are happening every day. I'm just seeing new names, which is just a cow paddock, rezoned. But let's say there's 350 real suburbs and there's about 150 made-up suburbs in Melbourne that are probably going to end up real suburbs in 50, 100 years. Like Thornhill Park. It's not a real suburb, it's just a bunch of houses and a cow paddock, okay? So just because it's got a name and it's got a suburb postcode doesn't mean it's a real suburb. But there's different constraints. So what's happening at the moment is because COVID wiped out thousands of developers and builders, the industry has been decimated in Melbourne, and a lot of tradies are not working in the industry anymore. They've left the industry. There's been a huge exodus to Queensland and working on government projects. So there's a huge supply constraint in Melbourne, in blue chip areas where people want to live in, suburbs that are all the suburbs, at least 50 years old, that have really good schools, transport, accessibility to city, lifestyle centres, and no one's building new stock. And that's the challenge. A lot of developers are actually holding back because the other thing that's happening is construction costs, which is point number 4, are going up so much. The margins are not there. So a lot of developers are even hesitant to bring stock to the market because construction materials in some areas have gone up by 30 to 40% in 12 months. And so a lot of developers went bust in the last few years because they were completing properties with negative equity at the end, which means your fixed contract and your costs are higher than your fixed contract. So you're actually losing money at the end of the transaction. But definitely supply and demand, there's an oversupply of houses on the fringe suburbs. Because if you look at the fringe suburbs of Melbourne, and I've done this before on my YouTube channel, there's a great video which is called The Great Australian House and Land Trap, which I encourage you to check out. There's thousands of blocks that can be released tomorrow on the fringes of Melbourne, from Point Cook, Truganina to Wallen, Lawless to Pakenham and Berwick and beyond. But if you look at the suburbs that are close to the city and the Bayside, the eastern suburbs, the trendy suburbs, there's no land for subdivision left at all. You've got to rip something down, and that comes with a lot of costs and a lot of problems. And so population and jobs are the key driver. Labor's let a lot of people into the country. I'm a migrant myself. My mum and I came here from Poland in '85, so I'm pro-migration, guys. I don't want to sound like I'm anti-migration, but I don't think we should be bringing in millions of people without having the infrastructure to support the lifestyle. Because the problem at the moment is a lot of these estates that are on the fringes of Melbourne, people are really suffering. They've committed to mortgages, and they take an hour to get in and out of the city every morning. And even though these estates are 20, 30 k's from the city, there's only one train station and one road to get in and out. And so, I've covered this in my video exposing this issue in Melbourne, and developers don't care. And every time there's another road being built or a tunnel, the amount of sales they make on the back of that news makes that congested as well. And the tunnel just connected the other day in Melbourne, and I can tell you honestly, it hasn't solved any congestion issues in terms of transport at all. You're still in a car park. You're still going from Point Cook to the city in an hour if you're driving. So, and if you want to get the train, you got to park real early because the train car parks are very limited in these estates. So if you don't get there by 7 o'clock or 6:30, you can't get a car park. So this is the problem with these estates. You can't get to the city and you can't get to your job, and there's nothing in these estates. There's no good schools, there's no transport, there's no cafes, restaurants, shopping. This is why people don't want to live there. They want to live in these premium suburbs like Glenlavey, for example, but it's very expensive now, and that's the challenge. Now, I'm not here to talk about social commentary. This is not what this YouTube channel is about. This channel is about how to make money out of real estate, but I want to educate you that these are the considerations you need to be aware of, because these will make your determining factors about buying real estate in specific areas where you can make lots of money. Population and jobs are very important. We've got really good employment. We've got populations. I think it's off the charts now in Melbourne. People are just getting sick of it, quite frankly. Labor just brings people in to get the votes, which kind of I understand from their perspective, but it's we're all paying for it, guys. Construction costs are the biggest challenge at the moment. And as I mentioned before, I've had a lot of meetings last year with a lot of developers. And I work with about 60 developers directly that I'm sourcing properties from in Melbourne. They're probably some of the best developers in Melbourne. There's a lot of shonky ones, and there's a lot of horror stories, by the way, especially in the last 10 years. It's getting worse and worse in Melbourne for quality and control. But there's a lot of good ones as well. Like every industry's got the 80-20 rule. There's 20% of really good developers, and there's a lot of average ones. A lot of them are feeling the pressure because they're operating with fixed contracts, which means that you sign a contract and they have to deliver that product at the end. Let's say buy $1 million 4-bedroom townhouse. If their costs blow out to 1.1, they have to wear the costs. And because construction materials are going through the roof at the moment for various reasons, petrol prices, wars overseas, China, they're paying more for materials and more for labor, therefore they're not making their margins and they're feeling a lot of stress. So a lot of developers have pulled out of the market and they're not developing as many properties as they want to, and that has further constrained the supply part of the equation. Everything the government's doing, by the way, they're not solving the supply part of the equation. This is the issue. They're not creating more properties in key areas where people want to live. It's very simple to rezone a cow paddock 100 k's from the city and say we're building 300 new houses, but who's going to live there? Why would you live there? You might as well just go to Bendigo, Ballarat, to have a better lifestyle and get within 3 k's of the city. Why would you be 100 k's from Melbourne? That doesn't make sense to me at all. And this is the issue with Melbourne. This is some of the key considerations that you have to be aware of. So let's go through some of the things that I think are going to have an immediate impact on the property market this year. Cash rate is sitting at 3.6, so we've had a bunch of increases, and then at the moment we had a decreasing cycle, and now inflation's up at the moment, and a lot of banks have come out in the final quarter of 2025 saying, like Westpac and CBA, saying we're going to increase rates in 26. And that's very possible because inflation is a big consideration. The Reserve Bank of Australia, by the way, they kind of meet every month, and they make decisions on a need-to-need basis. They are there to control and keep inflation between kind of 2 and 3% roughly, and they also keep an eye on the employment figures. But really, that impact has different impacts on suburbs. It's not a one-to-one correlation. The biggest mistake you can make is think that if interest rates go down, the whole market goes up, and if interest rates go up, the whole market corrects. That's not true. In fact, the reverse has happened many times in Melbourne. I've seen interest rate cuts and we've had property booms. I've seen interest rate cuts and we had property go backwards by 10, 20%. And I've seen interest rates get cut and properties go down as well or go sideways. So different suburbs have a different correlation depending on who lives there and who's buying there with the interest rate based on the income of that person. The good thing about Melbourne and Sydney is that it's very geographically and demographically fragmented, and people tend to cluster together based on the same incomes. So if you're living in Toorak, for example, Melbourne, which has got a median price of 4.5 million, your income probably for the household will be over $500,000 per year. If you're living in Frankston North, it's one of the cheapest suburbs in Melbourne. You get a house for $650. Make sure you get a bulletproof vest as well. You can be on kind of 120. So those two groups of people have completely different pressures and considerations when it comes to what they do and where they park their money and how they, what happens if there's an interest rate cut. Like if you're living from paycheck to paycheck and the interest rates get cut, and you're saving yourself something $100 a month or $200 a month, then yeah, you've got less pressure. But if you're on $500,000 or $1 million a year, like you don't really care. Do you know what I mean? It's not like you're going to ring your wife and say, honey, you can get that 3rd pair of shoes this week because the interest rates have come down. Or, let's go to Europe now because we can afford. Like, they don't really care. And most of those houses are paid off anyway. So don't assume that everyone is in the same boat, because what I'm seeing in the media is they're grouping all of Australians. They're all the same. We're all the same. It's not true, guys. This is just baloney. This is complete madness. And this is where people get in trouble, because they just make these massive assumptions about the market. The fragmentation of the market is so extreme in Melbourne and Sydney. There's houses in Sydney for $80 million and $30 million and $10 million and $1 million. There's very different things happening in those suburbs. And if you think it's all the same people buying the same area, you're not going to make money in this industry. You're going to fail, or you're going to end up buying house and land packages and then 10 years later wondering why you only bought two and you can't get beyond the third one. So it's you have to dig deeper, and you've got to get around, especially the median price fluctuations, which are not a good indicator. So yes, if there's let's say there's an interest rate cut, and you've got a borrowing power of 500,000, you can borrow 558,000. So you can borrow 58,000 more. But when your borrowing power, this could be per individual, per couple, is 750, and there's an interest rate cut of 1%, your borrowing capacity goes up by 87,000. If you're on 1.5 million, it goes up by 175,000. The more you earn, the greater the amount it has the impact on you. But also, don't forget, people that are making 1.5 mil, they usually buy houses with massive equity injections and deposits. See, what people assume is that everyone just starts over again. So the person buying a $500,000 house puts a $50,000 deposit and pays stamp duty, and the person that's buying a house for 1.5 million or 2 million puts a $200,000 deposit and pays stamp duty. It's not true. Most mansions that are sold in Melbourne, let's say properties over 3.5 million to 4 million plus, usually they're cash transactions. There's very few mortgages at the highest end of the market. The higher you get, the lower the amount of mortgages, because people get equity from the previous sale and put it in, and because they've made so much money, they're earning so much money, they just pay their mortgages off. Like I used to work with a lot of doctors and dentists and specialists in medfin, anaesthetists. They're on, surgeons are on $1 million a year, 1.5. Anaesthetists are usually on that 500,000-600,000. Dentists are usually between 300 to 600, depending on how many hours they work. I mean, usually they're very conservative people by nature. So they buy a house, they usually pay it off in 10 years' time. And when they sell, usually they live in nice areas. So if they're selling a house in Armadale, they bought it for $1 million, they're selling it for $3 million. When they buy a house in Brighton, they're putting $2 million in equity into that property. They're not borrowing again from the beginning. And this is where people get in trouble. People assume that people that are buying houses for 4 or 5 million are also starting from the beginning and putting in a 10% deposit. They are not. They have completely different constraints. And that's why those markets react differently when it comes to policy changes, supply and demand, interest rates fluctuations, and unemployment figures. So it's a very complex thing to understand about what's happening, dynamics of every area. So yes, like if you look at Westpac, for example, they've come out to saying we're going to increase rates. They were cutting rates on the fixed products for last 6 months in 25. I think there's going to be a small increase this year. Some of the banks will come in and start increasing rates. But if you look at the global markets in the last 18 months, well, you can see that on the screen, like New Zealand had, 9 cuts. We can see that Canada, 9 cuts. Europe as an area, so the European bloc, 8 cuts. US at 5, UK 5, and we had 3 cuts in Australia, -75 basis points. I think we have a lot of way to go. Either they're independent, and I get all that. I think that the banks, as a pattern, I think we're in a downward cutting cycle, even though short term we could have another couple of increases, but eventually we're going to go down. I just can't see the reason why these interest rates will stay so high, unless the economy starts overheating again. Melbourne new building completions are record low levels. You can see that historically, this is where the Albanese government has failed, because they've never built anything. They're not builders, developers. But their target was 240,000 homes per year, and this is where historically we've been, which is the red line. So you can see the gap is just tremendously high between what the target is based on migration coming to the country versus the reality. And this is a good thing for investors. The bigger the gap, the bigger the gap between the optimum level that the industry is creating versus what we are actually creating, the more pressure there is on prices everywhere. But the pressure varies from area to area because, as I mentioned before, some areas have massive amounts of land that can be released tomorrow, thousands of blocks, like Wallard can release. You can release Roxborough Park, for example, South Morang. Beyond South Morang, there's just cow paddocks and kangaroos, and you can release 10,000 blocks tomorrow by Burbank, Simmons, Australand. But if you look at St Kilda, I mean, there's no room. There's no land left. You got to buy something that's old, probably 100 years old, rip it down and build, which is very complicated. So remember, there's different constraints in different parts of Melbourne. Vacancy rates have a huge impact on landlords. There's an exodus of landlords at the moment from Melbourne because of land tax and because of complications with tenants' rules. And I think the tenants' laws that have come in are very good. And look, I've updated all my properties for compliance, and it's all to do with basically from everything from security to smoke alarms to conditions of the property. And I love looking after my tenants. I go out of my way to fix ovens, air conditioners, fences, whatever they need. I get it fixed immediately through my property manager. I don't do it myself. I pay professionals to do it, but I'm very good with it. And I think the better they have the conditions of where they live, the more comfortable they are, the longer they stay. So you want happy tenants. You don't want to be that tight ass landlord that doesn't want to fix anything, and they have to wait for things to get fixed, especially like air conditioning, security, anything like that. But a lot of landlords don't want to do it. They never had the intention of looking after the tenants, and they've exited the industry. There's been about 10,000 landlords that have left in the last 12 months. Who cares? It doesn't make any impact on what I'm doing. And none of the investors that I do work with, they don't really care. A lot of amateur landlords have left the industry. And that means that when I say amateur, it's a mum and dad investor, one house, one other property, probably within 5 k's of where they live. So they live in Vermont, they buy a house in Mitcham, they don't know what they're doing. Then they've got to spend more money. Let's just sell it. And they sell it, and who cares? It's just like, sell it, don't do it. Go into share market, go into crypto. I mean, it doesn't make a difference. To me, this exodus of investors, they're not really investors. Investors are people with more than 6 properties. That's 0.1% of the market. These mum and dad investors, they just get blown around like a paper bag in the wind. And this is the same with the stock market, same with crypto, same with real estate. They're not investors. They're just a person that bought something. You got to define what an investor is. But yeah, there's definitely been huge pressures on rents, which is fantastic if you're targeting the right high income area. And you can see that rental yields in some areas have gone backwards. So the latest Victorian report found that the number of rental bonds active in Victoria, along with the number of homes available to tenants, fell 1.5%. A bit more than 10,000 residencies to 655,626 across the past financial year. A reduction indicates fewer landlords making homes available. Fantastic, because then I can increase my prices. And while the June figures are preliminary and reflect the smallest decline in 18 months, 2.5% reduction noted in Homes Victoria March report. So you can look at the inner Melbourne, for example, the median price, inner Melbourne's got a lot of apartments, 640. The quality change is negative 4.5, annual change is 3.2. So you can see that the increases and decreases in different areas, which is fantastic. I mean, the less competition you have, the greater the pressure on your properties to increase rentals. And this is why the areas that I've been targeting in the last 12 months for my clients, like BlackRock, Hampton, Carnegie, rents have gone up by between 15 to 20% on 3 and 4 bedroom townhouses. So they've gone from 900 to 980, for example, to 1,000. It's been great. I mean, that increases your serviceability, increases your cash flow. So all these things are actually good, because what the Labor government is doing, Jacinta Allen's completely useless, but what she's doing is she's actually creating more pressure on property prices in the right areas for sophisticated investors, because of all the policies that she's actually instigating, which is fantastic. The funny thing about Labor, guys, is that every significant property market boom that has occurred in Melbourne in the last 30 years has been with the Labor government. And what happens is they actually implement strategies that have the unintended opposite impact of what they wanted the strategy to do in the first place. And the best examples is a 5% deposit, which has overnight increased property prices, which they denied that would happen. So the liberals actually don't do much for the property market. They kind of leave it alone. They don't want to change negative gearing. They leave it. Labor always tried to say, we have a solution, and then they make it even worse. So I'm thinking of changing from Liberal to Labor. I've always been a Liberal supporter. So the impact of low vacancy rates on the Australian residential property market, you can see there, you've got the inner Melbourne market, and then you've got apartments and rents. And so it's just been going from 2020 to 25. It's gone up across the whole board by, 10%, which is fantastic. I wouldn't touch apartments necessarily, but even apartments now, and they're here to stay, are going to do really well because they're so cheap compared to detached houses. Most people now will be targeting under the kind of $800,000 mark. You won't be getting a house in Melbourne soon at all. In any suburb, you'll be getting a 2-bedroom apartment. So Melbourne vacancy rates over the last 20 years, you can see there, like the average vacancy rate for a healthy market should be around 4%. They say 3%, but I don't agree with that. I think it's a 4%, 4.5%. We can go to an agency. Back in the day, you get a printed sheet of all the rentals, and you get like 50 properties to choose from. Now you go there and you'll probably get 5. So vacancy rates now are kind of down to below 1% in some of the areas that I'm sourcing in. For Melbourne, 1.8%, June 25, but towards the end of the year was 1.6, and they're record low. And there is no solution to actually address this situation, which is fantastic because if interest rates go up, guys, but your rentals go up further, if interest rates go up by 25 basis points, but your rent on your property goes up by 1%, okay, which is a lot, or 2%, comparatively speaking to interest rates, then you're in cash flow positive territory. So I don't really care about increases or decreases in interest rates. What I do care about is targeting suburbs for my clients and myself where I can aggressively increase rents beyond the market norm. That's what I'm looking for. And how do I look for those? I target areas with high income demographics only, where the rich people live, and I try to buy townhouses there and have the growth on the back of the market. The worst thing you can do is buy the cheapest suburbs with the lowest income demographics in Melbourne, which is Melton, pretty much Melton South. Don't even invest there. Don't even don't even drive through there if you can avoid it. Nothing's going to happen there, guys. It's like a teen arena concert. There's nothing good to see there. Melbourne population growth is out of control. So Melbourne population growth is now 5.39 million. In 1950, population was 1.33 million. Melbourne has grown 76,000 last year, which is 1.44% annual change. The year before was much higher. The year before was even higher. But then 5.4 million, guys, that's too many people. We're not building the houses that we should to support this population growth. And this is why properties keep going up in value, even though Melbourne's been stagnating, going sideways the last, since COVID-19. You can see the Melbourne population is just going off the charts, and this is the growth factor. The number one fundamental growth factor is people. If you take people out of the equation, there's no growth. If we had no population growth in Melbourne, I would sell all my properties tomorrow and put into shares and crypto. I wouldn't be in the real estate market. If we have a negative population growth, which like Japan is experiencing that in some suburbs right now, and there's houses just vacant sitting around, you can pick them up for virtually nothing. Italy's got the same problem. There are villages in Italy we can buy a house for $1. Why? Because there's no population growth. So people coming to an area is fundamentally the most important thing that's fueling the market. That's like at the biggest macro level. Micro level, there's different things happening, but macro level, that's the fundamental thing. If that ever stops, now you don't want too much growth either, because then there's other negative aspects, but you want very stable, consistent growth that's occurring. New house builds are rising faster than inflation, and this is the thing that's happening in Victoria. The average construction cost of a house, and this is detached house, as of end of year 24, was 561,484. That's just construction, and then this is not including land acquisition or anything like that, or bureaucracy or fees or stamp duty. This is just to build, and then went up to 589, which is 4.9%. And remember, inflation is 3%, 3.5. So you can see that there's a huge gap between inflation and the change in construction. Now, this is the average construction. As I mentioned before, if you're developing house on land, it's very cheap, accessible, and you're building on mass and you get economies of scale. If you're building 3 townhouses in Mentone or Brunswick, you're going to have different constraints. You're going to be paying 20, 30% more per year in materials compared to last year. So remember, and I don't source anything, and I don't do house and land estates at all. I have access to them. I just don't like them as investments. So let's have a look at who do you listen to work out what's going to happen this year. And these are some of the best sources of information that I encourage you guys to tap into. Go to their website, download their reports and articles, tap into them, follow them on Instagram, follow them on on X, and also just read the reports, whether it's quarterly, half yearly, yearly. So KPMG, definitely, they do a lot of customized reports for developers, builders, and government bodies. Domain.com.au, realestate.com.au, very good because they have access to a huge database of sales from real estate agents. Australian banks are very good as well because they have entire economic departments of very sharp people that are paid lots of money to analyze the market all day long. And remember, the banks are the most profitable institutions that we have in Australia. They make billions of dollars per year, and they make billions of dollars by not losing money. So they spend a lot of time and resources far beyond what you and I could ever spend, making sure they understand exactly where the market is in order to maximize exposure to the market. SQM Research and Henry Todd White Valuers, which is the biggest valuation company in Australia. So if you just follow these 6 independent, and by the way, none of them sell real estate, which is also, good. There's an old joke: how do you know real estate's lying? Because his lips are moving. So you just got to be careful with people that are selling stuff. And I know I'm saying this and I'm selling properties, but I'm a buyer's advocate and a sourcing specialist. I can source anywhere. I'm not a developer selling a project. So, but I do sell real estate. I source it for my clients. You just got to be careful with people that are selling an area and then making the area look better than the other area. I can source in any suburb in Melbourne. I'm not a developer. I don't have any constraints. I can recommend every suburb equally. So I'm completely unbiased. There's no, I'm not trying to push some area and make it look better or worse. It is what it is. I have specific ideas about areas, and some of you might not agree with them, but it is what it is. I make a lot of money out of my ideas. Melbourne is tipped to lead the 26 property boom from KPMG. So KPMG has a lot of very sharp people, like Dr. Brendan Rain, who says that the gap between Melbourne and Sydney now is extreme. And depending on which research you look at, it's literally, $600,000 gap. Melbourne's around the $1 million mark. Sydney's 1.6 to 1.8. So that last time we had the gap was 99, and then Melbourne boomed in 2021-22 by 20-30% per year to catch up to Sydney. So the Melbourne has stagnated because Dan Andrews shut us down for a long time. Land tax was introduced. There's a number of financial constraints, and economic things and policies that have impacted our market negatively in Melbourne. But Melbourne's not going to go anywhere, guys. It's going to stay here. And within that time frame, there are suburbs that have experienced double-digit growth, which I've shared with you on other videos, which I'll show you today as well. So KPMG number 1 is a strong rebound for Melbourne in 26, predicting a property capital growth of between 6.6 for houses and 7.1 for units, which is cool. So very healthy. In terms of what it is. You can see that Melbourne so 25 for houses, 5.2 was the prediction, and 6.6 for December. And for units, which is apartments, 3.6, virtually inflation now 7.1. And I agree, apartments are going to start going up because they're so cheap now. You can still get 2-bedroom apartments in reasonable areas in Melbourne between 550 and 650, and you can't get a house for under $1 million. So if some people, like if they want to live in a particular area, like if you want to live in Camberwell and you got under $1 million, you're probably not going to get a house or even a townhouse. You're probably going to get a 2-bedroom apartment, and that's your only option. Otherwise, you can't live in Camberwell. And so this is the common kind of theme. Melbourne is becoming expensive, which is really cool. So, healthy direction, definitely recovery. The banks, they spend a lot of money and they're the most profitable institutions, but they change their mind very often. So ANZ 25 forecast was 5%, 5.8 for 26. And this is for all of Melbourne, this is for combined capital cities. CBA 6 and then 4% for 26, bit negative. NAB 6 and 6, and Westpac 6 to 9, which is interesting. The first home buyers grant, which was introduced by the Labor government, which is a 5% deposit, unlimited amount of places, no income limits, and no lenders mortgage insurance, created a mini boom in Melbourne for properties under the $950,000 mark. You can see there was a cap on what this 5% deposit could have done. If you're a first home buyer, by the way, guys, this is your chance to get in. I will do anything you can, because if you got $50,000, you can buy a house and land package in Melbourne or a townhouse. It might not even happen again. It's gonna, because it's already fired back on them. So if you can see there in Melbourne 950, this has immediately had a negative backlash from experts in the industry saying all it's going to do is fuel property prices, which it did. And the fact is, it's not even a debate now. And I'll show you the numbers. So, for example, in Melbourne, value change above price caps was 0.4%, so above 950. Value below the price cap, so 950 down, was 1.7%. So the difference in capital growth over the last 12 months, and the market's been dead in Melbourne in 25, was 1.28%, which is 91 percentile ranking, which means that it did the opposite of what it was intended to do. It pushed up all the prices for under 950 properties. So properties that were 550 went up to 600. Everything went up by 20, 30, 40 grand instantly. So the Labor government does a really good job sorry. I find it hilarious. It's a never endless source of humor for me, because Albanese is the most useless, spineless leader that I've ever seen in my whole life. He's such a left-wing communist, and all his party is just completely useless. But they're very good for me because my property portfolio keeps going up in value because of the mistakes they keep making and the policies they keep creating, which is fantastic. Keep going. I mean, they're not going to change who they are anyway. You can't take Albanese and you can't change him. He's not going to become a capitalist, right-wing person tomorrow. He's going to be a left-wing communist until he dies. Whether he will acknowledge that or not, it is what it is. But that's what they're going to do, and they're going to hire people that will align with their ideologies, and those ideologies always push up prices. So this is not about politics. It's about, if there's a Labor government, chances are there's going to be a property boom. So 5% deposit scheme has created a massive surge in property prices under 950. In fact, when it was first introduced, our phones were running hot. I was getting emails from first home buyers, which I don't even deal with in our company, because Investors Prime is predominantly a company that is designed to look after private investors. We've had first home buyers ring me all day long, email me saying, I'm pre-approved for 870, I'm pre-approved for 900. What do you have? Can you help us with the property? I've seen your YouTube video. Which areas can we source in? Which areas can we buy into? And I do have some options, by the way. So I help those people out. I actually like helping people out that are just getting into the property market, because if I can give them a sense of idea of areas to avoid if they want capital growth. If they don't want capital growth, it's fine. Then I can spare them all the pain of having a property growing just above inflation or below inflation in an area where they could actually make some real serious money. So the 5% deposit definitely has increased property prices. The market jumped, 34%, which we knew, and obviously property prices under 950 had the most pressure on them. Now let's have a look at the future. Australian home prices set to surge in 26 as rate cuts ignite market. So SQM research is really good. I'd follow SQM for a long time, pretty much when they started, which tells you how old I am. I'm nearly 50, I'm 49. But they've got kind of scenarios that they do. You get scenario 1, scenario 2, scenario 3, and 4. So scenario 1 is based on the base case. This is like we think this is what's going to happen. 25 to 50 basis point rate cuts in mid-26. Steady but sluggish economy. Inflation 2.5 to 2.7. And Melbourne's going to go between 4 and 7%. So that's like scenario number 1. Scenario number 2 is no rate cuts until late 26, which could happen. 7.5, then 0.75 to 3.2 yearly average. Slow economy, Melbourne's between 2 and 6%. Scenario 3 is global spillover, slowdown spillover. So stuff happening overseas, spilling over into our market. 0.75 to 1% rate cut throughout the year. Unemployment rises to 5.5. Melbourne's doing 6 to 10%. Interesting. And then scenario number 4, economic rebound. So they're not saying they know what's going to happen in the economy. They're saying if the following cases occur, this is the likely impact on property prices. And the economic rebound would be rate cut throughout the year, 0.5 to 75% or 75 basis points, which is 0.75% of 1%. Lower inflation, so inflation dropping from where it is now, which is too high, to 1.9 to 2.1. And then unemployment going back to low 4s. Melbourne will go between 7 to 11%. So there you go. SQM research, still very positive though. There's no negative, stuff there. Very positive about the Melbourne property market. What I believe is that if interest rates do come down, and there'll be at least 1% interest rate cut to 0.75 or 75 basis point cuts in Melbourne and Sydney, these are the areas that will benefit from those cuts the most. And I'm going to talk about, and this is why how fragmented it is in Melbourne. And I'll come back to this and I'll show you the areas that I think will benefit from this. The final report that I read is the Herring Todd White Monthly Market Property Cycle Report, which is something I recommend. If you're going to read one thing per month, guys, this is it. Just download this report from Herring Todd White Valuation website. It's free. You don't need to subscribe or anything. You just give them an email. They send you the report. And it talks about the property clock. And Melbourne at the moment is a state of recovery. So it's kind of, 6 is the bottom of the market, 12 is the peak. And from 12 to 6, there's a decline in the market. Doesn't mean the properties drop everywhere. Some areas will go sideways. Some areas will go slightly up. Some areas will go down. But the majority of the market, in terms of the median price movement, will go down as a principle. From 6 o'clock onwards, the market starts going up again. When we get to kind of state of recovery, which is now, we're looking at around 7, 8 o'clock. We're looking into a growth trajectory, which is where we're on now. You want to secure as many properties as you can between 6 and 7, 8%, 6 and 7 and 8 o'clock on the property clock, which is the bottom of the market. Once we get from 9 to 12, that's where the highest growth occurs. That's where you get double-digit growth, 20% plus. Now, this isn't guaranteed. This is just an observation based on past data. And national clock, this is for apartments. So let me just show you some areas that I've been targeting. By the way, not many people know what this movie is anymore, and I've also included this. If you know these guys' pension is close, it's the A-Team. No one knows who the A-Team is unless you grew up in the 80s. Let me show you some areas that I'm targeting, which I think will do really well this year, and I'm focusing all my attention there for my private clients that are buying the 5th, 6th, 7th, 8th, 9th, 10th property. I'm also buying in these areas myself. So I want to share with you real suburbs that I think will do really well this year. Now, when you get these reports saying Melton, Cranbourne, it's just, what are you talking about? It's just insanity. These areas will do nothing. They're oversaturated with stock, and it's all investor driven, and it's all house and land estates. So the number one area for me is Box Hill South, the Box Hill North, Mont Albert, Surrey Hills, Mont Albert North, fantastic. Very expensive, pricey. Box Hill and Box Hill South will do really well. Box Hill North will do very good as well. Blackburn South will do really well. Nunawading and Forest Hill will be very quiet. Same with Mitcham. And Vermont South are already booming from last year. So this is an area that I'm watching for townhouses, 3 and 4 better. They get expensive. I think this area will be the number one cluster of suburbs that you should be watching this year in 26. I think they could do 18.4% potential future growth. So Blackburn North, Blackburn South, Box Hill North, Box Hill South, Burwood East, Forest Hill, Mitcham, Mont Albert, Nunawading, Surrey Hills, Vermont South. In fact, Box Hill last year did 20% in a depressed market, in median price for houses. This is an example of something that, these are all sold, by the way. I'm just going to show you the kind of properties that I have access to. So what I like in Box Hill is duplexes where you have 4 or 5 bedrooms, double car garage with a backyard. So this could be a block that's 700, 800 block cut in half. And these tend to go for about $2.5 to $3 million. So if you're a high income earner, this is something you want to buy, park, and just sit on it. It's negatively geared. It's going to give you a lot of tax benefits and huge potential for capital growth. This is a cheaper project in Edgar Road that was sold. And once again, this is a cluster of 6 or 5, sorry, I should say. Obviously with small land component in the other one. And these were selling for 1.55. So if you have just one, remember the land is very expensive in Box Hill and Box Hill North. So if you have just 2 properties, you're going to be paying at least $1 million to $1.5 million just for the land plus the build. The more you have in the development, where it's 4, 5, 6, 7, the lower the price of the property. It's cheaper to build the property. It's more expensive for the land. You can't get a block in Melbourne now under 1.5 million in a good area. It's impossible. So, and I'm saying a decent block. So that's just land cost. This is Vermont South, which is a development that's sold out. And these were here 1.25, and these are 4-bedroom townhouses, and there was 9 of them. Another area that I'm focusing on is Essendon, and so especially I really like Essendon, and I've been focusing on Essendon for the last 10 years, and it's always just one of those areas. It's the Toorak of the West, as they call it. Moonee Ponds is so expensive now. Ascot Vale's done really well. Flemington is fantastic. But now I think Needry and Essendon North, which is Killer Road, Essendon North will do really well. And Needry, Essendon West will do really well. Even places like Killer East and Middlelara, don't go to Avondale Heights. It's too rough. But that's the areas that I think you can do really well with townhouses. You can still get even at 1 million, 1.2. That area would just boom. I think it's going to be really good. Flemington did 11.3% last year, by the way, in a depressed market. So there you go. Another area that I'm looking at this year is Doncaster, Templestowe, Doncaster East. Donvale and Park Orchards are all big houses, 4,000 square meter blocks, big mansions. Warrandyte's too far. Unless you want to live there, you can buy houses there, but I wouldn't buy townhouses in Warrandyte. Wonga Park's, it's all lifestyle blocks. It's, people go there because they were a 2,000 square meter block, 3,000 square meter block. But what I like is Doncaster East and Templestowe. They've come up really well. The shopping is phenomenal. The cafes, the restaurants. There's a lot of people that have grew up in the area and they can't afford a house. They don't want to have a 2,000 square meter block. They want a townhouse, low maintenance. So Templestowe, Doncaster East. Doncaster's always been good. And Templestowe lower as well. Bulleen, still early days for townhouses. I would still go for detached houses in that area. That area is going to be huge. It has potential for massive capital growth, 17.4% in the next few years. This is an example of Doncaster of a duplex. Once again, you've got your 4-bedroom. I'm not going to go through these. I just want to show you an example of the kind of stock that I've got access to. These are all sold. Most of them have already completed developments and they've been leased out. They're not available for you to buy. I just want to show you some of the projects. So I'm a big fan of these duplexes where you have double garage, 3 or 4 or 5 bedrooms with 4 or 5 bathrooms. These are 4x4, 2 garage and 5 bathrooms. And they're just shy of 2,095,000 and then 2.25. This is another one in Doncaster, another example of property. These are a little bit cheaper. There's 4 in this development. They're more compact, but you still have essentially a 3-bedroom, 2-bathroom, or 3-bathroom in some instances, plus double car garage, and they're selling for 1.85. Here's even a cheaper project in Doncaster East. I especially like Doncaster East because it's much cheaper. It hasn't got the name as Doncaster. A lot of cafes. Tends to be younger audience in Doncaster East. So once again, you have 3-bedroom, triple-story townhouse, so lower land footprint, cheaper, lower land tax, very good rental. These rent out instantly. I mean, we're talking 1 week or 2 weeks, depending on the time of the year. And then $950 for the cheapest one. I would say 1.395 for the average 4-bedroom one. Another area is Boroondara, which is a really good area in Melbourne. Obviously, it's the cream of the suburbs. Q East, Balwyn North, Balwyn, Hawthorn, probably the second most expensive suburb in Melbourne after Toorak. Canterbury, Camberwell, Surrey Hills, Glenrose, Ashburton. Phenomenal suburbs. Apartments do really well in these suburbs. If you get an apartment development where there's like 5 or 10 with courtyards on the ground floor, and any townhouse that you can get your hands on. Don't do high-density apartments. Camberwell and Canterbury has a lot of high-density apartments being built, and they've failed. They haven't appreciated value at all. Even around Camberwell Junction, a lot of apartments have had no growth in 10 years' time. And I'm talking about apartments where there's 50 to 100 in a tower. Great location. I love Camberwell Junction. I'm there all the time having lunch with developers. Giorgio is one of my favorite restaurants in Melbourne, but it just doesn't work. Hawthorn is the same. Hawthorn East, many apartments. There's no growth. So you've got to be really picky with apartments, but there are some that are worth investing in. Just know exactly what to look for. 17.3% for those areas. Once again, Canterbury did 15.6%. last year, which is in a market that was depressed completely. And this is an example of Ashburton, another duplex, 2.695. This is Bowen North. There's 3 net development, 1.445. So that's a very good project. 3-bedroom, 2.5 bathroom, double lockup garage for 1.5 million in Melbourne. That's kind of your entry level bread and butter townhouse in Melbourne. You know, people ring me up and say, "Do you have anything for 500?" I had a financial planner ring me a few years ago. It was funny, and he says, "Conrad, I'm looking for $500,000 townhouse in Melbourne." I said, "Yeah, so am I." He goes, "What?" "So am I. If you find them, ring me. I'll buy them all." There's no such thing. That's not even construction costs. Like, who's going to sell you a $500,000 townhouse where it costs probably $750 to build? That's without even margin. So, you know, a million is entry level now in Melbourne in a normal area. You need 1.5 for a normal townhouse that would work, which is, and this is like a normal townhouse, entry level, double garage. You've got an open plan living, patio at the back with open plan, with sliding doors, and upstairs you got the master bedroom, walk-in robe ensuite. You've got a retreat area and 2 bedrooms. Very basic, but minimum standard that I look for. And you're looking at, you know, 1.5 million. Bayside. The Bayside is where I live, my favorite area in Melbourne. So you got Brighton. Brighton's very expensive. You never get the rentals there. Brighton East is also super expensive now, and Hampton. But Hampton East and Hyatt are really good. Sandringham is very expensive, and Cheltenham are very good for rental. Blackrock for high end, you know, 3 million plus, and Balmoral is very good. They're starting to do some subdivisions in Balmoral. Very tightly held area though. People don't want to move out of Balmoral. Bowie's great. It's one of those areas where people stay forever. They stay there for 30 years. But anywhere in this area, you can buy something with a significant land holding. As long as you can afford to make it work with the numbers, buy it and keep it indefinitely. These areas are going to just keep going up in value indefinitely. 16.4% for those areas, especially Hampton East and Hyatt, which are the cheapest, and Cheltenham East. This is an example of Bentley East. Bentley East is going through a roof at the moment, 1.85 million. And this is, you know, 2 single garage or 2 garages and 4 or 5 bedroom townhouses. This is an example of Port Melbourne as well. Port Melbourne's it's further closer to the city, but it's an example of a development that we had, which is really cheap, 995,000 for 2 bedroom townhouses. Port Melbourne is very hip, very young, a lot of cafes, restaurants. It's 3 k's from the city, on the beach, and it's got hundreds of cafes and restaurants. A lot of people just go there running in the morning on the beach. It's a fantastic suburb. You know, it's got everything going for it. These townhouses were fantastic. They were 995,000, completed 100% and with tenants. So if you're interested in a product like this, give me a call, send me an email. This is what I source all day long. 999,000 for the last remaining ones. There was a few earlier on for 995. Now, here's the thing. I do have a crystal ball. I know what's happening in the future. Here's what I'm going to leave you with some thoughts about the market. So those are the areas that I'm targeting this year. There's definitely other areas that I'm targeting as well. But those clusters of suburbs I just mentioned before is where I'm focusing 80% of my effort this year for my private clients. And I'm sourcing predominantly brand new properties off the plan from the best developers that operate in those suburbs. So if you're interested in any of those suburbs, give me a call. This is a study that was done a few years back now by Aussie Home Loans and CoreLogic, which is now Cotality, predicting that the average house in Australia will cost 6.3 million in 20 years' time. Projections show the median price will reach that figure in Sydney by 2043, up from 1,030,000 today, which now is nearly 2 million. And Aussie Home Loan surveys predict the average price will hit 5.8 million in Melbourne, 2.9 in Canberra, 2.5 in Perth, 2.3 in Brisbane. Biggest increase in Melbourne. Imagine you could go back, because 2043 will happen very quickly. Imagine you can then go back to 25 and then buy these properties at a fraction. In Melbourne, the median price now is 1 million, just over a million. Some say it's between 800 to 900, but depending on which, you know, reporting agency you listen to, because there's 6 different independent companies that collect data. But let's say it's $1 million, you know, going to 5.8. Like, if you knew this was definitely guaranteed to happen, what would you do this year to make things happen so you can secure as much of this action as possible? Because once it gets to 5.8 million, guys, you're going to be if you're on average income, you're gone out of the market forever. There is no coming back, not even close. I would say if the average income in Melbourne is 100,000, whatever it's high nines, this is the last decade we can secure property and get into the property market. And this could impact not only you, but your future generations to come. So if you miss out on this next property boom in Melbourne and median price goes to 1.8, 1.9, which it will, it's just a question of which year it's going to happen in. It's not a question of if it's going to happen. It's a question of when and how quickly. Then after that, it's going to be completely unaffordable. And a significant part of society is going to be locked out of the housing market forever. We're already creating a whole generation of renters in Australia, like in Europe. In Europe, majority of people rent. So the dream of home ownership is something that was a reality in the 80s, and now it's a far, far distant reality for most people. So if you can still get into the market, guys, if you can make it work, especially with a 5% deposit, I encourage you to take action this year. Take advantage of the government schemes that are in place for you to get into the market, and then leapfrog from one property to another, use the equity, and build up your property portfolio. Remember, the average house in Australia will be 6.3 million in 20 years' time. And this is going to happen with or without you. You can either be part of this or you can be watching this on the sidelines. What are you going to do about it? Remember, the houses were very cheap in the 80s, guys. This is what's been happening since the 80s, the 1800s, I should say. Property prices were super cheap. And look what happened in the last 30, 40 years. The market's just been going like that. Yes, short term, there's economic events. There's going to be economic crises. There's going to be downturns. There's going to be currency crises. There's going to be economic meltdowns. There's going to be stock market meltdowns. But you look at the trajectory of the average property in terms of this is from 1960 to 2025. I mean, it's the average house now, 700,000 for Australia. And it was super cheap in the 60s. So we're talking about, under $10,000. Bitcoin's the same. The amount, and I got on Bitcoin very early on, under $5,000, and all I keep hearing is it just goes up, and every time it goes up, there's a correction, it's dead. And there's a whole part of the community that rejoices, and then it goes back up again. And then there's a bubble, and then it goes down, it's dead again. And now it's going again. And these people are largely uneducated. They don't understand the Bitcoin halving. They don't understand all the different factors that are driving cryptocurrency and how now Bitcoin is pretty much the gold standard in crypto. It's become a source of storage, decentralized storage. And I don't think it's going to disappear anytime soon, but there's a lot of people that are skeptical. They're hoping the market's going to crash to zero, and they would love to see people lose money and get wiped out in Bitcoin. The same with real estate. There's a lot of people that would love to see real estate getting wiped out. It's just not going to happen, guys, in my opinion. Because God's not making any more earth and the population keeps swelling and people have to compete over finite resources. So if you can get into real estate market, guys, this is it. The biggest thing I can leave you with this year is because there's so much money involved in real estate, there's a lot of these so-called experts coming in, buyers, advocates, gurus. They're young kids. They've never been around the block. They're probably living with parents and renting. Some of them don't have any properties behind them. And there's a lot of AR reports that are completely worthless, predicting hotspots in Melbourne. I get these reports. I download them all the time. I have a bit of a laugh. And I've got these reports from 10 years ago, not obviously AI. From 20 years ago, it's all just baloney. 90% of it worth the paper they're written on. Stick to the fundamentals, guys. The fundamentals don't change. Quality over quantity. Listen to people like Warren Buffett. Investors should be skeptical of history-based models constructed by a nerdy-sounding priesthood using esoteric terms such as beta, gamma, sigma, and the like. These models tend to look impressive. Too often, though, investors forget to examine the assumption behind the models. Beware of geeks bearing formulas. Beware of geeks bearing formulas in 26 in the real estate market. There's a lot of geeks claiming they have magic reports, that they have entire departments analyzing the market all day long, and there's 3 hotspots in Melbourne. And I can tell you now, guys, it's all bullshit, okay? Download the reports for yourself, check them 12 months from now and see how much they've gone up by. Because I've been doing this now for 15 years, even 20, downloading these reports, and most of them, 90%, complete rubbish. Stick to the fundamentals. Look at where the property market's going. Refinance at the top. Do nothing when it's 3 and 4 o'clock. This is from Herrington White Valuers. You at 6 o'clock, you prepare to be financially ready to buy. You buy investments between 8 and 9, and then you lock in your lines of credit at midnight. The boom, the majority of the growth happens between 9 and 12. Melbourne's at 8 and 9 o'clock right now. It could even go backwards this year slightly, but eventually it's going to go from 9 to 12. And the more you have between 9 to 12 on the property clock, the richer you'll be for the next cycle. You can set yourself up for life. Yes, it's always nice to buy at the bottom of the market. And I've done YouTube videos and I've told people, if you've been to my live events, I've called the market multiple times saying, guys, this is the bottom. You know, November 22, I've said this is the bottom, it's going up, and it's gone up way past that since. You know, these are my emails that I've sent to my private clients telling them this is the bottom, get in if you want to. But who cares about the bottom, guys? Stick to the fundamentals. You know, this is the gym in December, this is the gym in January. Second, because January 1st is a public holiday, unless you've joined up, you can't go in. This is the gym on the 2nd of January. December, January, and February. And that guy that's there in February, that's when you build. Remember, when you build a body, you build it during the winter months. You don't build it in the summer, which is when everyone joins and they all fail. Same with property. If you're trying to time the market, I have never met one property investor in 30 years' time that has successfully timed all the markets around Australia, leapfrogging from one market to another, buying at the bottom before the peak happens. I've never met anyone. I heard the stories, and I've heard companies that do this for their clients. Show me the client with 10 properties. Show me the properties. They just don't exist, guys. Okay, so timing the market is not a strategy. Time in the market is a strategy. So stick to the fundamentals. Buy whenever you can buy. It's always very difficult to buy. Stick to the fundamentals, and when the market booms, you're just going to look really smart. That's the secret to it. There's going to be economic events from now to the end of time. You know, we've had the Asian currency crisis, the dot-com bubble bursting, the GFC, the China glut steel glut, I should say. We've had COVID-19. All these different things will happen, and people will sell at the bottom, and then they realize if they could just hold on to that property, they would have made so much money in the future. They rob themselves of all these future gains. So my advice is stick to the fundamentals, buy and sell. Never buy and sell. Buy and hold, never sell. The property market is a long-term game. There's going to be sometimes 5 years where you get no growth, and then you get all the growth in 1 year to average it out. So for me, I think Melbourne will do around 7 to 8%, but it's not important what Melbourne does because, as I mentioned to you before, Melbourne is extremely fragmented, and I'm focusing on specific areas which I mentioned before, those suburbs. I'm focusing on quality this year at a discount price. I'm not focusing on any hotspots or anything that's going to boom. I'm focusing on the fundamentals, mainly the Bayside, the eastern suburbs, but the cheaper suburbs of the eastern suburbs and the Bayside, because the best suburbs have already boomed and they're so strong, they haven't moved backwards at all. So I'm looking at places like I mentioned, Bentley East and Hampton East and areas like that. If you're interested in learning more, guys, I encourage you to attend my real estate investing fast track weekend, which I'm running again this year from time to time. We're running less and less of these in my singular office because we're just too busy at the moment looking after existing clients. But if you scroll down below, we're going to realestatefasttrack.com.au. You can check out the dates. Tickets are only $47, plus you get a hard copy of my book, Australian Real Estate Investing Made Simple. And there we're going to go through the strategy of how clients are building multiple, huge property portfolios that can leave a legacy behind and create financial independence, how to smash your mortgage in record time from 30 years down to 15 or less. Also, how to borrow money, how to structure your portfolio to create passive income, how to refinance properties, and also which areas to target, which areas to avoid. We do a lot of cash flow analysis on different properties, land tax, cash flow analysis. The numbers, fall in love with the numbers, guys. Don't fall in love with the aesthetics of the property. So after you come out of these 2 days, you know exactly what to do and when to do it. And the team also that you need to have with you, meaning your mortgage broker, your property strategist, your solicitor, your valuer, to make it all happen. So it's a 2-day event. It's literally just covers lunch and venue, which is our venue, just cleaning, literally. I'm not making money out of these $47 tickets. I just do it because I love doing these events. I have a blast doing these. So feel free to register. They do sell out really quickly. and I'm looking forward to meeting you in person. Some of you who have already been to the event, have read my books, have been following me on YouTube. Some of you could be ready this year to enter the property market for the first time. I encourage you guys to book in a strategy session with myself for 1 hour. It's free. All you got to do is scan the QR code there, or just send me an email. And there, what I'll do, I'll sit down with you, I'll work out where you are, where you want to be, and we'll develop a whole plan of how to get from A to B using property as a vehicle, brand new properties in quality blue chip areas. Now, if you're doing renovations, subdivisions, this is not for you. I can't help you. If you want to have cash flow positive property or holiday lets, I can't help you. It's only blue chip properties, blue chip areas. So think of me as a Mercedes dealership. If you want to buy a Merc, come to me. Now, I don't sell Toyotas, I don't sell Camrys. Camry, there's nothing wrong with the Camry. It's a very nice, reliable car. I just don't deal with them. So if you want to have blue chip tenants, blue chip properties, brand new, no headaches, off the plan, low land tax, and cash flow neutral, slightly positive or slightly negative, that's what I specialize with my company, Investors Prime Real Estate. And I help clients build wealth passively by accumulating quality assets in quality suburbs. I don't think there's a substitute for quality, guys. You can't get around it. It is what it is. So we develop a whole plan. Most people never accomplish their goals because they fail to plan. And if you fail to plan, you plan to fail. So you come out of there with clarity. You have a whole plan in writing of what you can do, how much you can borrow, and what team you need to use, and which areas you can target in Melbourne. It's free. There's no strings attached. You get access to all my mortgage brokers, accountants, property solicitors, conveyancers, the whole team if you don't have one, and also the properties that I source and developers that I source in the future. These are some of the people that I work with. So obviously Cameron from Changing Places Real Estate for Property Management. Stephen McClutchy, Director of Loans Australia. He's done nearly $1 billion in settlements. James Blake from Brandy & Co. He's a self-managed super fund specialist and also a specialist on asset protection and trust. So it's a strategy session. It's literally like a blueprint. So if you're kind of confused about where to get started, or you're looking at multiple options, if any of that resonates with you, definitely drop me an email directly. The minimum qualifying criteria is that you got to be able to borrow at least $700,000. I don't have any stock, and I'm not going to have any stock under $700,000 in Melbourne, because the suburbs that you can get that stock, I don't believe in them. And I can't be bought. So, it is what it is. Most of the properties that I'm targeting are kind of 850 to 1 million as an entry level. And majority of the townhouses that I'm sourcing are kind of 1.3 to 1.5, which is the average townhouse in Melbourne. So if you're a single person, if you can borrow 700,000, get a pre-approval, or as long as you're on kind of 95, 100 grand a year, and you got a bit of equity, 112,000, no problem. If you're a couple, you need to be in that 140 per year, plus about 120,000 in equity. If you're interested, definitely drop me an email, conrad@investorsprime.com.au, or just scroll down below, click on the link or the QR code, and I'll see you on the Zoom call. That's it for me, guys. I hope you have a really good financial year this year. There's a lot of opportunities in Melbourne. Melbourne's about to boom. Whether this year or next year doesn't make any difference. No one can pick it accurately. If they can, they're lying to you. I've been doing this for a long time now. Nearly 50. I've been involved in the real estate market the last 30 years from different angles. And I can tell you, Melbourne is just a turning point now before it gets very expensive. So if you can get into Melbourne, if you want to have some quality stock, this is the potentially the following year, and that's it. And then it's going to boom, and it's going to leave a lot of people behind where they'll never get into the market. So this could be the definitive year. Get the education, get the team, stay away from hype. Don't buy into the hype. Don't buy into special hotspot reports. Stick to the fundamentals. Get a professional that can help you. And I wish you all the best this year. This is Konrad Bobilak. I'll see you on the inside.